Good afternoon and welcome to our second series of live webinars. During the second series, we are exploring some of the challenges faced by the investment industry. We will inspire you how behavioral tech helps in digitally converting your die-hard savers into investors, retaining them and rejuvenating your client base. I'm Laurent Lamblin and will be your host today. I'm pleased to welcome Prof. Milo Bianchi as our speaker today. And just to give you a brief overview about who he is, well, let's resume his bio now here, as he's a professor of finance at the Toulouse School of Economics. His current research agenda focuses on fintech and on sustainable finance, with specific focus on individual investors. His work has been published in leading economics and finance journals, and Milo is a junior member of the Institut Universitaire de France, director of the FIDIN initiative and member of the Sustainable Finance Center and the Digital Center of Toulouse School of Economics. Milo has received his PhD from the Stockholm School of Economics and has held research positions at various institutions, including MIT, Paris School of Economics, University College London, and Shanghai University of Finance and Economics. During our last session in March, Professor Alessandro Previtero of Indiana University shared some very interesting and thought-provoking conclusions about financial advisors. They clearly contribute to financial inclusion. They also clearly contribute to retention of clients during volatile markets. But, and there was always a but, with a non-negligible impact on performance. So now, we are all curious, what about robo-advisors? What do we know? What to expect? Can they contribute to better decision making? What about financial inclusion? What role does artificial intelligence play, and how will robo-advisors evolve over time? During this webinar, Professor Bianchi will explore these questions. He will share his findings based on some of his recent publications. And I'm sure that he will inspire us with his findings, as they could have serious implications for investors, but also for the investment industry as a whole. After Milo's session, we will take time for your questions. So please do not hesitate to post your questions, comments, feedback, or share your thoughts in the chat. I don't know exactly where the button of the chat is on your screen, but hit it, put your question there, and let's have a very interactive session today. So let me invite Milo to take over the screen for the next 40 minutes, and I will see you again after his presentation for the Q&A. Thank you and enjoy the presentation.
Okay, so thank you very much for the invitation. It's a pleasure to be here, and I'm happy to share my thought with you, and I look forward to get your comments. Let me share my screen. The title of today's talk is about Robo-Advisor, what we know and what we expect. And most of what I'm going to say is based on joint work with Marie Brière, who's working at Amundi, and also at the University of Paris-Dauphine. And essentially, I'm going to structure the talk into parts. I will start with a brief introduction on why do we think robo-advisors are interesting, and it's going to build really on where you started or where you stopped last webinar with Alessandro Previtero. I will spend most of my time talking more specifically about work that we have done on a robo-advisor, which I think was pretty interesting in many ways. And I will spend the last part of the presentation to give you some more general thought on what I think could be interesting development of AI applied to financial services. Okay, so the context in which we put our interest in robo-advising, and I don't have to tell you that there's been a really large increase in interest for robo-advice, both in the industry and in academic research, are essentially coming from two facts. The first is that we just have accumulated evidence that households are not always well equipped to take financial decisions. Okay, there has been a lot of literature on various biases that households have been exposed to and how important these biases are for welfare and for performance. Second piece of evidence is that traditional financial advice has its limits. Okay, so one natural response to household limits would be to delegate to professional manager. But as I think Alessandro Previtero has discussed extensively in the last webinar, there has been accumulated evidence that this is not always, there could be some limit to how much you can delegate. Now, based on that, there's been an increasing interest for automated financial advice, which are often called robo-advisor. And essentially, I think there are two main questions, at least these are the main questions we've been trying to address. The first is whether automation can improve financial decision, and can it be the case in particular for those who have been traditionally excluded from financial services, so can it promote financial inclusion? And second, can we, by studying robo-advice, can we say something on the complementarity or not between automation and human reasoning? Okay, do we think this robo as a substitute or a complement for human reasoning? Just to elaborate a little bit on this point, why do we think that robo-advisor can potentially improve financial decision and financial inclusion? The first and very important fact is that robo have low operating costs. So in terms of capital requirements that are needed to access a robo versus a human advisor, in terms of management fees and so on. So there is the possibility of being more inclusive. And I'm quoting here a survey that we have written with Marie, I'll get back to that, in which we try to document this reduction in fees. The second is that robo are based on accountable procedure, so there could be less scope for biased incentive on the part of the advisor. We may be more trust on the procedure that are used. And third, robo might use more information or different sources of information than what has been done in traditional advice. Now, of course, there are potential pitfalls, there are potential risks. One is that there's a group of investors which are maybe less experienced, less sophisticated, which have more potentially to gain from accessing robo-advice, but at the same time, they also be more reluctant to try. And I'll get back to this issue. And second is that, like for many financial innovation, it could be that those who need it the most don't use it, or they end up misusing it. So there could be some cross subsidies between more or less sophisticated investors. Now, in terms of the broader question about human-robo interaction, and I will spend quite a lot of time on this in the presentation, I think that looking at this from the angle of robo-advice is particularly interesting because there is something special about financial advice in which trust is central, trust is key. There are scholars who have compared financial advisor to doctors, in which people go to the advisor also to look for some peace of mind, to decrease their perception of risk. And at the same time, we have evidence that, especially for financial services, people are reluctant to rely on algorithms. Okay, so there is algo aversion, and it's particularly severe in the case of financial services. Now, we are particularly interested in looking at human-robo interaction in this context for two reasons. One is that this interaction can promote reliance on the robo, can reduce algorithmic aversion. And again, we collected some evidence along this line in this survey that I'm quoting. And this will be particularly interesting in times of a shock. Okay, when we receive a large shock, COVID comes, or there's a large shock in the market. this is the case, this is a situation which particularly need trust in the robo, and this interaction between the human and the robo could be particularly useful then. And the second reason why we think this interaction are interesting is that there could be important scope for complementarity between the robo and the human. So traditionally, robo-advised has been seen as a substitute for the investor reasoning and judgment. But the robo we're gonna study is really more intended to promote own judgment and not to substitute the investor, but to complement the investor. Okay, so this speaks a little bit to the broader question on whether automation can actually be a tool to improve financial literacy and financial capabilities in general. So I'm going to discuss more specifically these topics in the context of a paper that we've been working on with Marie Brière, and the paper is called Augmenting Investment Decisions with Robo-Advice. So in this paper, we have exploited the introduction of a robo-advisor by a large French asset manager on a set of employee saving plans. So I'm going to go back to the specificities of the robo and of the investment under study. But let me emphasize a few points already. The first is that in this context, in the robo that we study, the investors are the ultimate decision maker. So we are not talking about robo-managed accounts, which are the most typical case, especially in the US, in which investors just completely delegate the management of their portfolio to a robo. Here, the human always keeps the control or keeps the final decision on whether or not to implement the advice which is proposed by the robo. So we're going to focus on human-robo interaction resulting from this. So that's why in the title we talk about intelligence augmentation rather than artificial intelligence. So this distinction is sometimes made in which artificial intelligence is often and traditionally about substituting the human with the robo. Here is more augmenting the human with the robo. A second important fact in this aspect in this study is that we have a lot of investors with small portfolio with little experience in investing in the stock market and typically no access to financial advice. So there is a large debate on whether the stock market is augmenting wealth inequality, whether automation or financial technology can promote financial inclusion and can actually be a way to at least limit this tendency towards more inequalities. And we're going to try to exploit the fact that we have a lot of small investors in our data to try to speak to this debate. And last, I'm going to spend a little bit less time on this today, but we really exploit in order to document our finding, to document them in a robust way. We exploit the knowledge that we have about the functioning of the robo. Okay, so because we were partnering in a close way with the asset manager, we had access not only to the data but also to the knowledge of how the robo, what are the algorithms that the robo uses, and so we can use this knowledge to basically to generate our findings in a robust way. Okay, so I'm going to talk about, before going more into details of this paper, let me put this a little bit in the broader context of the literature. There is a growing literature on how robo-advising, how having access to robo-advising affects financial decision. And I'm quoting here two recent survey articles on these papers. The key distinctive feature of our study is that our investors tend to have a long-term investment, so long-term horizon, which is pretty uncommon for robo-advisors, and that we are not small investors. So because of that, we also relate to this literature on automation and financial inclusion. There's a nice paper from the US exploiting, looking at this. And relative to this paper and to a lot of the debate, the key sort of aspect is that we show that the robo can promote financial inclusion without having the fact that the investor lose control over their portfolio. Okay? So we can keep at the same time investor in control of their portfolio and promote financial inclusion. And we think this is an important fact when we think about the long-term consequence of access to the robo automation as a way to have the robo promoting learning and financial capability. Third, there is a literature on asset return and wealth inequality, showing basically that more wealthy investor gain higher return in the stock market, and so access to the stock market is a way to amplify wealth inequality. And we're going to suggest that automation can at least partly limit this pattern. And finally, there's literature on financial innovation and risk-taking and stock market participation, which and our key aspect relative to this literature is that we focus on this human-robot interaction. Okay, let me tell you a little bit more about how we get to these points. So the data we have access to are a large set of employee saving plan in France. So in this plan, each year, employees receive a sum of money that they have to allocate between a menu of funds which are proposed by their employer. The investment tend to be long horizon. Depending on the contract, the investment is locked in for 5 years or until retirement. And the employee can basically increase the investment in this plan as they wish. They can also rebalance their portfolio over time. Now, the robot treatment that we are going to exploit was as follows. The robot starts as a very standard robot, which elicits information about the investor. And there are many questions, but essentially this boils down to having information about 3 dimensions of the investor. One is the risk attitude of the investor. The second is the financial knowledge, and the third is the horizon. And then the robot will propose, based on this information, an allocation to the investor within the current menu of funds, which is already proposed by the employer. And the rule mapping between the information and the allocation is as you would expect. If people are more risk averse, they will be offered a more larger share of equity. Same if they have more financial knowledge, and same if they have longer horizon. Now, this is the first decision of the investor. The investor has to decide whether to accept the advice or not. If the investor accepts, the robot will implement the advice, will implement the new allocation, and if not, the service is terminated. So that's the first treatment. Then there is a second treatment, which actually we're going to look at in detail, which occurs over time. So for those who have accepted the robot allocation, the robot will monitor their portfolio, and whenever the current allocation gets too far from the proposed allocation, because, for example, there was a market shock, the robot will send an alert, an email, and will propose to the investor. You will say, okay, there has been a shock. your allocation is far away from the target, you should connect to the website and rebalance your portfolio. So just to visualize a little bit how the robo looks like, this is this is in French, but let me translate it to you. This is saying which type of investor are you, and these are going to be the different profile from prudent to dynamic and so on, audacious. And so in this case, the investor was based on the answer to this set of questions. The investor was profiled as moderate. So based on this profile, the robo gives a recommendation, and the way in which this is presented is this is the current allocation between money market fund, bonds, and equity, and this is what the robo would suggest to the would advise to the investor to do. And then of course you can click on the icon here to get more details of which exactly are the equity funds and so on. Okay. So if the investor accepts, the robo will implement this allocation. And the second, over time, you might get this type of email, which is written alert on your personalized saving, in which is saying, so we are noticing that there is an important distance between your target allocation and your current allocation, and this could have been, for example, the result of a shock to the financial market. Please connect to this to your personal website and rebalance your portfolio. Okay, and again here the investor, the human, will have to decide whether to ignore this email or whether to connect the team to the website and rebalance the portfolio as suggested by the robo. So the robo is proposed to the employers in September 2017. Okay, so this is an agreement between the asset manager, who is managing all this set of employee saving plan, and the various employers. Okay, and essentially the employers were asking for solution to advise the investor at a relatively low cost. And it's important to notice that without the robo, the employee, the investor would be left completely alone in this decision. Okay? So the comparison we are going to make are going to be between people who have access to the robo and people who choose the investment by themselves. Okay, so the robo was introduced in 2017, and we have monthly data from September 2016 to November 2018. So we have some period before and after. And the sample is composed of different group of investors, which are interesting for various reasons. We have all people who have taken the robo, who have decided to take the robo as of November 2018. So these are about 15,000 investors. And then we take random samples of other groups of investors to make comparison. We take a group of non-takers. So non-takers are those investors who work in some firm which proposes the robo service, but this investor decided not to take the robo. Then we have people who have not been exposed. So these are investors who work in firms which do not propose the robo service. And then we have a pretty interesting sample, which we call robo curious. So these are investors who have got to see the recommendation of the robo. They answered the question that the robo was asking, and they observed what the robo would suggest them to do, but then they decided not to take the robo. Okay? And these are a pretty interesting investor, because for those investors, we know exactly what the robo would have done, in terms of allocation and also in terms of alert over time, but still they don't receive the service because they choose not to have the service. So they are a very nice group for comparing the result. So for those investors, we are basically combining different type of data. We have account level data from the asset manager on the portfolio choice of this investor, the return that they get, the risk that they are exposed to. We have data on the digital footprints of this investor so we record the number of connection, the time that they spend on the platform, and so on. This is a useful measure for us of attention of the investor. And then, as I was saying, we also have a pretty detailed knowledge of the data that the Robo is generating. Okay, so the profile that the Robo is giving to each person that has gone through the survey of the Robo, and the allocation that the Robo is proposing to investors. Okay, let me give you the main result of this study, and because of limits of time, I've decided just to list the main result, and basically for each of them you can find more details in the paper, but we can go through more details if you are interested in some specific result. I would be very happy to go more in detail with you. So please ask a question if you feel like. So the first set of results is about who takes the Robo. So who is trusting the Robo, and so if you correlate the probability to take up the Robo with observable characteristics. Okay, so we know the gender, the level of education, we have measure of income and wealth of the investor, and so on. These are hardly affected. So Robo take-up is hardly affected by observable characteristics. Okay? So it's not that the Robo is taken up only by the rich or the more educated. It's pretty, the take-up of the Robo is pretty widespread across the population of investors. In terms of fraction of wealth that is devoted to the Robo, because investor here can have several contracts and they can have the Robo only on a subset of this contract. So you can look at the fraction of wealth that is devoted to the Robo, and this tends to be more important and be larger for investors which have a smaller portfolio. Okay, so small investors tend to allocate larger fraction of wealth to the Robo. So maybe they are the one who need the Robo the most. The second finding, which is pretty interesting, is the fact that investors are more willing to accept the Robo allocation if these allocations are far away from their current allocation. And this finding is interesting because it's pretty the opposite of what happens with human advisor. Okay, so maybe you've discussed this a little bit last webinar with Alessandro Previtero, but the one piece of evidence we have with human advisors is that human advisors tend to be pretty accommodating with investor. They tend to suggest allocation which are not too far from what the investor thinks are good allocation or the current allocation. And here with the Robo is a bit the opposite. The investors are willing to take up the Robo if the Robo is proposing something which is very different. Okay, so second set of finding is about the effects of the Robo on investor attention, trading activity, and equity exposure. So what we observe is that the Robo, so people who take up the Robo actually increase their level of attention to the portfolio. And we measure, remember, this level of attention by looking at the amount of time that they spend on the company website. So this suggests that investors do not see the Robo as a substitute for their own attention, but rather that the Robo is inducing investors to pay more attention. to the portfolio, and this is actually pretty persistent. This is true even beyond the time in which investor subscribe to the robo, even beyond the time in which investor receive the money to be allocated across the funds. So there is this another piece of evidence suggesting that there is complementarity and not substitution between the robo and the investor. Second, this increased attention is also associated to increased level of trading activities. And again, this is persistent. This is even after the subscription, after the time in which the investor subscribed to the robo. And also to a net increase in the investment in the plan. Okay? So as you know, there's a debate on whether employee saving plan and pension plan in general are underfunded or not. In this case, having access to the robo was a good instrument to increase the level of investment in the plan. Okay, so we observed a net inflow of about €84, which is much larger. The average net inflow is €1.7, so it's much larger impact. Third result on this is about the effect of the robo on risk taking, which we measure as exposure to equity. So we have different methods to estimate this robo effect, but if you compare how people who take the robo change their equity exposure relative to people who were not exposed to the robo, for example, you observe that the robo is associated to an 8% increase in the equity share, so in the share of wealth allocated to equity, relative to an average of 18%. So it's a pretty substantial increase. And we can repeat our estimates in another way by exploiting the discontinuity in the algorithm of the robo. So the robo is giving you a profile, and depending on the profile is proposing you an allocation, and there are discontinuities in this mapping that we exploit, and in that case you get an increase about 5% in equity share. So that's the main result on, let's say, on the static part of the robo. You know, what happens when people take up the robo. There's another important part of the robo treatment, which is associated to rebalancing over time. Let's see. I mean, I'm checking in the chat if there are some urgent questions or if I can postpone. Let me continue this, and then if there are urgent questions, please don't hesitate to jump in. So, what is the effect of this alert that the robo is sending? We think that looking at this alert is pretty interesting for two reasons. One is to get a sense of whether investors trust the robo. Remember that alerts are generated typically after market shocks that change the relative value of the various parts in investor portfolio in a way that brings the portfolio too far from the target. Okay, so they are typically generated after large market movement. And we think that it's particularly interesting to look at whether investors trust the robo in these times, in times after big market movements, and whether these are good times in which the investor has control or the robo has control on the portfolio. So that's the first reason why we think these alerts are interesting. The second is that we know from previous studies that actually this rebalancing behavior can have first-order impact on performance. In particular, we know from previous studies that less sophisticated investors tend to wrongly time the market, and this could be very harmful for their portfolios. So here the robo is inducing people to pay attention to the portfolio and to rebalance the portfolio in a way to keep basically constant weight over time. So the question is whether investors are willing to follow this advice or not. And it seems that by and large, our investors are willing to follow this advice. So the alert induced the robo takers to decrease their distance from the target by almost 5% more than the robo-curious. Okay, remember, the robo-curious are those who have watched what the robo is proposing, but then decided not to take the robo. So conditional on being alerted, the average distance between the portfolio, current equity share, and the target one is 11%, and the average changing distance is 2.3%. So the fact that the robo induces to decrease the distance by 4.8% more is large impact. Second, investors are more willing to follow the robo when the robo is suggesting to reduce the exposure to equity, rather than when the robo is suggesting to increase the exposure to equity in this email. We do also a placebo test in which we look at the effect of the alert which the robo is sending because of regulation, because of MIF regulation. You have to elicit information about the investor in a regular way, but these alerts do not have any effect actually on rebalance. Again, we can redo the analysis in an even more precise way, because we know that the alert is sent only if the distance is above some threshold. So we can exploit this discontinuity, and again having a significant result there. Third main point, or fourth main point, is about the effect on returns. The effect on returns, so here we look at realized return, just to make it simple. Then in the paper we also look at expected return. So here in terms of realized return, the robo is associated to an increase in realized return by 5.4% per year. And when we control for risk, because the robo is also inducing larger risk, this effect is about 3%. And the robo fees are much larger than that. The robo fees are the order of 0.04%. So this suggests that this potentially the robo can have large impact on long-term wealth accumulation. And I think even more interestingly, we try to we decompose this total effect of return between two effects. One is a static effect, which is occurring when the investor changes the allocation at the robo take-up. And it could be that this is good for the investor because the investor was choosing an inefficient allocation, something, let's say, below the frontier, and the robo is pushing the investor at the frontier. So that's one effect. The second effect is dynamic. The robo is inducing investor to change their rebalancing behavior, and this might also have important effects on performance. And essentially, what we show roughly in various specifications is that this rebalancing effect, this dynamic effect, is even more important than the static effect. Okay, so if you want to decompose the effect on return, you really have to be careful on the effect of the robo on rebalancing behavior. Last set of results speaks more directly to financial inclusion. So we look at how this effect changed over time, and how this effect changed depending on the type of investor, and in particular where they are larger for small investor. So what we observe is that the increase in equity exposure associated to the robo is larger for investors which have smaller portfolio and smaller income and smaller baseline risk exposure. So investor, to repeat, investor which are small tend to increase their equity even more when they take the robo. Those investors are also the ones who experience a larger impact on a larger increase in returns. So investors with smaller portfolio and investors with lower baseline return have a larger impact on returns associated to the robo. And so overall, this gives a sense that the robo can have particularly important impact on investors who have traditionally less access to financial advice. So let me conclude on this paper. I think that the main question, the main message we want to give out of this paper is that access to the robo can promote financial inclusion. And in order to understand the way in which the robo can promote financial inclusion, it's very important to pay attention to the dynamics of the interaction between the robo and the human, and also how the portfolio of the investor changes over time. There are many questions which are left open that we don't address in this paper, but we are currently working on, and in particularly, what are the long-term effects on the robo, and what are the effects in bad times. So the time that we are studying were pretty quiet time for financial markets. Now we are extending our analysis to more recent periods, so more turbulent period, and we want to see whether the people are still willing to look at the robo in those bad times. So let me stop here, and before going to the last part of the presentation, let's see maybe how much time do I have left. Do we take question now or at the end, as you want? I see there are questions in the chat.
Yeah, maybe we can just take a few questions.
Yes.
That are directly linked to what you said now. You referred that, for instance, gender affects take up of a robo. Can you elaborate on this gap?
Yes. So basically, what we observe in this table is that females are less likely to take up the robo, and actually, if you compare the effect of various other demographic characteristics, like age, the value of the account, and so on and so forth, the larger impact is driven by being female, and the fact is that females are less likely to take the robo.
Are less
likely to take the robo.
Okay. The increased trading activity that you saw using robos, is it more due to the attention, due to more attention to his investments by the client, or just to the follow-up mails that are sent to the investors?
Yeah, so it's both of them actually. It's
okay.
We observe increased attention, both of course when they take the robo, but also over time when they receive this email. So these emails are also an important way to keep up the attention of the investors.
Okay. And then I had also a personal question. You referred that the alerts are generated after market movements. Do the people also follow up on these alerts when markets are getting very difficult over a longer time frame? For instance, the beginning of the pandemic might be such a period where we had significant drops, and then sending out an alert to a customer might not really, invite actually to take up the proposal to increase equity share at that moment, or even maybe more recently what we saw following the Ukraine crisis. Absolutely. Meaning, what is the role of retention of robo-advisors, for instance?
Well, that's a very good question. Actually, that's the central question we are trying to address in this follow-up paper, because the way in which the robo, as you said, the way this robo is programmed is to induce constant weight. So, you know, if there is a big negative market shock, the value of equity would go down. So what the robo would induce you to do would put now even more money into equity. And this is something which typical investor find it hard to do. And so now we are extending our data to cover the COVID crisis that we thought was the largest shock we had recently. Let's see with the war. I mean, anyway, yeah. So I hope I will be able to tell you more maybe in the next webinar we can organize in a few months.
Also had another question that came in. It was more a general question. Do we address that at the end or do it now, concerning the European Commission that recently published a consultation paper related to today's topic, actually, a consultation that aims to promote financial inclusion and improve the decision making of retail investors by working on 3 pillars. One was uniform investor profiling procedures. A second one is a uniform framework for portfolio allocation. We go even further than that. And then a third one, quite revolutionary, the transferability of the above between financial institutions upon the request and with the consent of the investor. And maybe if you already have some thoughts there or topics that you have seen within your studies that might actually highlight this question here.
Yeah, so it's very important and broad question, and I'm gonna say something a little bit on this in what comes next. But what we essentially what we see in our study, so we did larger study on various robo-advisors. With Marie, we looked a little bit at how robo-advisor in other institutions work, and indeed we see that both the profiling procedure and the portfolio allocation, let's say, framework were not very sophisticated, and there were differences across institutions. Okay, the same person with this, so the same risk profile and so on could be profiled in a very different way across institution, and will be given very different advice across institution. And so we certainly noticed that there is this heterogeneity across institution. I don't have a strong view on whether uniform, making this uniform could be good or bad. And the reason why I don't have a strong view is that I don't think we got to the best way to. So these things are very difficult to elicit. Elicit what is the true attitude towards risk of an investor is something which is very difficult. Or mapping this risk and all this dimension of the investor to the optimal portfolio allocation is also something which is potentially very difficult. So it's pretty risky to stick to one way to do it and impose that way to do it to all the institutions. So that's why I'm a bit cautious when seeing, let's impose some uniform framework, unless this framework is very general. In that case, we can agree on that. But this is really related to the second type of thought. So maybe it's a good way to try to go to this. And basically, the last thought I wanted to share is come from this review of various robots that we've done with Marie. And what we observe is that most robo-advising today, even though there is a lot of, I'm sure you are following, a lot of debate, a lot of marketing also around artificial intelligence in financial services. In fact, most robo-advising today built on rather simple procedure, both when it comes to the information which is employed to profile the client, okay, how many questions you ask and which type of question you ask, and also on the way in which this information is used to construct the optimal portfolio. So essentially, in the way in which this information is used, most robo-advisors use model portfolio theory, and forms of artificial intelligence are hardly employed when it comes to the implementation of the portfolio. Okay. So the question is why? I mean, we asked ourselves, why is it the case that these models are not more complicated? They are not more fine-tuned to the various specificities of the investor, for example. And essentially, the type of answer that you can have to this question are, first of all, that we don't know how to do it. So maybe there are technological constraints or there are knowledge constraints, and we don't know how to apply artificial intelligence in financial service. And I think this answer can be dismissed. We have a lot of evidence now on how artificial intelligence can be usefully applied to financial services. So apart from knowledge, another big constraint is the legal framework, and there is a large debate in the US, but also in the European Union, on what are the legal constraints that the robo-advisor should be submitted to. Should we treat the robo-advisor exactly as a human advisor or not? And of course, the more you make artificial intelligence entering the picture, the more you have to ask yourself how much responsibility you want to keep on the robo and on the advice that the robo gives. Okay? So I'm not going, because of time, I will not go through the legal debate, even if it's pretty interesting, and there's no consensus, of course, on this. So what I'm more interested in elaborating on is the fact that maybe having more artificial intelligence is just not desirable. It's just we don't want to have that. And we don't want to have that maybe because at least the traditional way to look at artificial intelligence is to look at to develop algorithms which are black box, which makes it hard to provide explanation on why the robot is suggesting a given portfolio, and possibly are also very sensitive to individual characteristics which are hard to measure. Okay, so this goes back a little bit to what we were discussing before on how how much you want to make the recommendation of the robot sensitive to variables which are likely to be measured with errors. So the more we go into this direction, the more we are likely to exacerbate some biases, some so that could be algorithmic discrimination and so on. The more we are likely to be exposed to new forms of risk in terms of financial stability, in terms of cybersecurity, and the more actually we are going against this promise of promoting financial inclusion through financial technology. Okay, so algorithmic complexity has been is likely to be particularly problematic for people with lower financial capabilities, as it has been the case, as we observed throughout the history, when we introduce more and more complex financial products. Those with lower financial capabilities are those who are likely to suffer from that. So when we, based on this insight, when we think about what to expect for the next generation of robo-advisor, there are essentially two paths that you can look at. One is that we will follow this trend of having more and more automation, having more and more data, and having more and more complex model in the robot. And if you follow that path, you are likely to hit against some key challenges, in the sense that to the extent that having more AI means having more opacity, you're gonna miss on these key promises of increased accountability and financial inclusion. And moreover, this is gonna be eating again on what we were discussing before, which is the constraint of trust. Okay, so trust is key, and having more complexity is probably against having more trust in the robot. So what would be an alternative path? An alternative path would be to devise algorithms that can be easily interpreted and evaluated. And there's a literature in data science studying the determinants of trust in technologies, and in particular in machine learning technologies. And they basically what they say, they say that developing trust requires developing algorithms which are fair, explainable, accountable, and safe. And why is this important? Because essentially there are two components of trust. One is extrinsic trust, which is based on how the model behaves. So you can look at how the robo is performing in financial market, and you can try to construct counterfactual performance that you would have had without the robo, and then you trust the robo if the robo is performing well. So that is what is often called extrinsic trust. But there is also intrinsic trust. Intrinsic trust is more based on the understanding of the underlying mechanism, underlying algorithm, and the intrinsic trust requires, for example, being aware of what are the conditions under which the robo is likely to perform well versus not well, or more generally, understanding why the robo is proposing to do something rather than something else. Okay, so when we were discussing before of getting this email alert in which the robo is suggesting to rebalance the portfolio to keep constant portfolio weight, intrinsic trust would require understanding why the robo is suggesting to do that way. So there is a pretty active, it's a very active field in artificial intelligence called explainable artificial intelligence that is basically studying the way in which we should devise algorithm if we want to keep explainability as a key sort of like a key feature of the algorithm. And it could be that maybe the model behind the algorithm is very complicated, but still it is explainable because you can evaluate how changing the input of the model will change the output. Okay, so in the robot case, how changing the profile of the client will change the suggestion that the robot will give to the client. So the mapping could be very complicated, but the client has to be able to evaluate how the various input are translated into the output. So I think I see that time is up. I just wanted to say that this is not a new issue of in artificial intelligence. Even in the 70s, when we were looking at expert system, or more recently when we looked at the recommendation system, there was this idea of explainability, but it has become very important now, also in the EU, also in light of recent EU regulation, which puts as one of the rights of the investor the right to explanation. Okay, so I can, as an investor, I could inquire about why an algorithm is proposing me to do something. Okay. So we. I see time is up, so let me not go through this. Let me just give you some reference if you want to read more about that. I will be happy to answer a question or just send me an email after the presentation. So this is the paper on augmenting investment decision I was talking about, and this is a broader review article arguing that for the next generation of Robo-Advice, we should have less AI and more XAI, so more explainability in algorithm. Okay. So thanks a lot for your attention, and I'm happy to leave a little bit of time for final questions if there are any.
I'm just checking in the chat if there are other questions coming in. Just a second. No, nothing special coming in. Okay, in that case, we'll be able to round it here. Okay, well, in this case, I can conclude today's session.
Yes.
And of course, please keep in mind that we have a next section coming up where three experts, Gert-Jan Hogendoorn from Objectway, Rajul Mittal from Cinecron, and Gosha Fortuna will tackle a very hot topic in the investment space today, meaning ESG and MiFID II. It will not be a session limited to some regulatory insights about ESG, but a hands-on session on how to use the new ESG regulation to streamline your current investor journey well beyond the August 2nd deadline. If you want to attend, please do not forget to register for this co-hosted session. Visit our website at everyoneinvested.com/webinars, everyoneinvested.com/webinars. And of course, recordings of today's session will be made available later to the attendees. And I would be grateful also when leaving that you give us some of your feedback on today's session. It always helps us to improve future sessions. Once again, thank you very much, Milo, and thank you all for joining today's session, and looking forward to see you again on April 21st. Thank you very much again, and bye-bye.
Thank you. Thank you. Bye.
Thank you very much.